And up and running. Okay, so couple things. Merry Christmas, almost. I am not going on next. If Christmas is next Tuesday, guess where I will not be? Let's see. I should have looked. I'm giving people a chance to get on. Yeah, I have a feeling Tuesday is not going to happen. Okay, so we have a couple things I want to touch base on. A lot of people having trouble with the risk and stuff, so we can always do that. I have one of the videos on there. Another one is customer accounts. So I'm going to go quickly through customer accounts, and we'll go from there. So when a person walks into your room, office, whatever it is, what do you need from them? What you need from them is you need their name, their address, and are they of age? Are they legal? Are they 18? If they're under 18, you cannot open an account. You cannot do a joint with a parent. The only account that they can do with under 18 is an UGMA or an UTMA. UGMA or UTMA. So again, they walk in, name, address, and are they of age? Okay? Okay. Now, 1 second. Somebody just said they can't find it. Now, hopefully you're on. So now, if I have, so that there it is. So that works. You should try to get their social security number. So here's where it differs. FINRA doesn't require it, but Patriot Act does. So like the CIP program, customer identification, you have to get some docs to prove who they are. So customer identification program, that's where we're going with that. So now CIP, you have to let them know that you have a customer identification program. You have to let them know about that. You have to, and every year you have to remind them that you have a customer identification program in place so that they are warned of that. So I walk in, open the account. You should try to get their social security number. You should try to get, if they work for another broker dealer or a public company. Why do you need that? Because if they work for a public company, you have to know if there's going to be an insider trading issue. If they work for another broker dealer, you have to make sure that you get permission from their boss. So all of you get jobs after you pass this stuff, you have to get permission from your broker dealer to open a brokerage account somewhere else. That's the big thing. You need that. Now, can you make recommendations yet? No, you have to do a suitability statement. You have to get all their information, their risk tolerance or time horizon. Time horizon is how long they're looking. So say they have a 15-year-old and they're looking for, they want to put their kid through college. You don't do it for 3 years because you're not paying for the first year. You have to pay for all 4 years. So it's really a 7-year time horizon. Okay. So you need to know time horizon. Time horizon is almost everything to do with suitability, which is one of my other videos. You have to know their age. You have to know their dependents. Are they married? Are they not? What's not their education, but what's their experience as far as opening a brokerage account, stuff like that. Now, the new account form, the suitability statement does not need to be signed by the customer. Remember that you do not need, permission from your employer first, right, before you open an account. You do not, I forget where I was going with this. If you open, the customer does not ever need to sign the new account form. The only people that sign it, the new account form is the principal. They may want your name on it, but the principal has to approve it. They cannot do any trades until the principal approves the account. You put the information in, they go, you got everything, boom. Now, all the information that you get for the customer, okay, awesome. Perfect, I see that. Nice emoji. So now, all of that, you have to get that stuff, all the information you get to them, you will send to the customer within 30 days of getting it to get everything down. We okay with that? I like that. So now, if you want to open a margin account for this person, you have to get a margin agreement, of which there's hypothecation. Hypothecation agreement is you're letting them use the shares they buy as collateral for the loan. So margin is where you're borrowing money to buy shares. So you're saying, oh, I want to buy 10,000 IBM and only put down $5,000 and borrow the 5. Hypothecation says, oh, the shares that you buy are collateral for the $5,000 loan. has to be signed. The other one is the margin agreement or the credit agreement is basically saying these are the terms of the loan. This is your minimum maintenance, which is 25 or 30 or whatever it is. Those are the terms of the loan. Those both have to be signed, hypothecation and credit agreement. If we have there's another part of it called the loan consent. That's allowing your shares that you buy to be lent out by the broker-dealer to short sellers. You do not have to agree to that. Okay? You do not have to agree to lend your shares out. It's optional. The other two are not optional. Okay. Now, okay. I look less tired with my glasses on. Okay. So now, if you want to open an options account, remember this DATO 15, DATO 15. Remember that. Disclosure doc first, always first. Then approval by the principal or the ROP. Then you can trade, and then the options agreement has to be back within 15 days. DATO 15, disclosure, approval, trade, options agreement 15 days later. If they don't return it, it's not like you do anything to them. You don't take their firstborn. What you're doing is you are just telling them they can't buy or increase their percentage, their positions. They can just liquidate them. Okay. That's the beginning of accounts. Now, Brian asked one, which was great. ACAT, an account transfer form. So that is like, say you get your licenses and you know that, so let's say you, you're at JP Morgan or wherever you are, and one of your new clients you cold call, and he's over at Deutsche Bank, and you get him to come over to you or her to come over to you. There's a form for that. Your customer will then fill out a form listing all his positions. Now, that's called the TIF or an ACAT, a transfer in force, or a ACAT, account, confirm, and transfer. You will then send that form, ACAT, to the original firm. So you're at JP Morgan, Deutsche Bank is where it's coming from. You will send that form to Deutsche Bank, the old firm. They have 1 day to verify. 1. Then they have 3 days to deliver the shares. Brian, I hope that helps you. I hope you're on. So he said he took the exam today. So Brian, 1 day to verify, 3 days to deliver. That means deliver them to shares to JP Morgan. If there's any discrepancies, it's kind of too late. The only thing that doesn't have to be delivered, if Deutsche Bank has like their own product that isn't transferable, like a private placement that they set up or something, then that's the only thing that won't be delivered on the 3rd day. They have to be. Okay? Good enough. Okay. So now let's hit some of these things. Okay. That is general rule for the ACAT. Yep. It's 1 day to verify, 3 days to deliver. Okay. So now I'm going to hit Brian first because he's always good. Okay. So now, what option strategy? I hope you can still see me. I think you can. What option strategy has the same risk profile as holding the underlying stock? Okay. So let's talk about this. So what has the same risk profile? So the risk is on owning stock is you have unlimited risk and unlimited gain potential and limited risk. Like you can only lose what you put in. So let's go with that. So if you buy a put, you're bearish, so that's out. If you sell a call, that's bearish, so you're out. So it's either sell a put, which has kind of like a little bit of gain potential and a lot of loss, but buying a call is almost the same as buying stock. So if you buy a call, you want it to go up and you have unlimited gain potential and you can only lose what you spent. So I would go with that. What product has the same risk profile as owning stock? Buying a call. Hope that helps you a little bit. Okay. What affects cost basis? Okay. So now there are cost basis questions. So a lot of it comes down to if you own stock, remember, cost basis is what you pay. Proceeds is what you sell it for. The difference is your gain. Remember that. Cost basis is what you pay. Proceeds is what you sell it for. The difference is your gain. So now, if I buy 100 shares at 50 or 5,000 is my cost basis. If I pay a commission, that increases my cost basis. If I sell a call against my stock position, it does not affect it. So remember this. You buy 1,000 shares at 50, that's 50,000, or 50 is my cost basis. Selling a call does not impact my cost basis. It's considered two separate transactions. You buy stock, pay 50. You sell a call for 50, call for 3. That $3 is a short-term capital gain. When it expires, has nothing to do with your stock. So there are 3 things that don't affect cost basis. If you sell a covered call, doesn't affect it. If you get a cash dividend, doesn't affect it. If you have accrued interest on a bond, does not affect it. So buying stock, selling a call, no interest. Getting a cash dividend doesn't affect it. And getting accrued interest does not affect your cost basis. Okay? Cost basis is what? Oh, it's what you pay for something. Proceeds is what you sell it. The difference is your gain. So every person I say this to, I ask the question, if you buy stock at 50 and you sell it at 60, what's my cost basis? What's my proceeds? Cost basis is 50, proceeds is 60, gain is 10. And when is it long-term? If I've held it for more than a year, not a year, more than a year. Okay. Now the last one he did, and then I'm going to go to Judy and somebody else. Okay. In regard to multiple options, I want to make sure that I'm thinking correctly when I see something that says the customer sold 10 call options at 2. That'd be 2 each for a total of 20, because that's so, okay. So now, so if you sell, hey, Misako. So now, Misako. So now, I know we've been texting. So now, if you sell an option, if it's break even, you don't care how many options there are. So if you buy a 50 call at 3, your break even is 53. If you buy 15 50 calls at 3, your break even is still 53. But what you actually spent total would be, so let's see, 150 call at 3 is 300. If you did 15 of them, you do 300 times 15. Whatever the hell that is, okay? 4,500. So that's what that would be. So if that's what you're talking about, if you're doing break even, I don't care how many options you do. If you're doing actual cost, I do care. So when I do problems, if I see, oh, he bought 8 50 calls at 4, I go, oh, break even is 54, and what's his cost basis? Then I multiply times the 800 or whatever it is. I hope that helps. I don't know if you're on or not, but maybe. Okay, so now that's him. Let's go with Judy, the one who got me that great vest that I love. Okay, so now, if multiple call dates are an answer, okay, so here's why. So if a bond is at a discount, you quote it at yield to maturity, because that's the lower of the two. If you remember the triangle that you all should have, it goes coupon, current, yield to maturity, yield to call. You always quote it at the lowest. So if it's a discount, you're going to quote it at yield to maturity because it's lower than yield to call. And issuers don't call discount bonds because, well, they don't call them because that means interest rates are higher. And why would they want to borrow money at a higher rate? So you always quote a discount bond at yield to maturity. Now, in a premium bond, remember, call date is the fact that you're getting called earlier than maturity. So if you buy a bond at 1,200, you're getting back 1,000 at maturity. So you buy a bond for 1,200, you get back 1,000 at maturity. So you're actually losing $200. Now, if you do to maturity, that $200 is spread over 20 years. So it's fine. It's $10 a year in a way. But if they call it after 5 years, you're losing that money in 5 years, not 20. So it's worse for you. So if you have a bunch of call dates, the earliest one is always going to be the worst on a premium because you're losing the money quicker. So I would rather lose $200 over 20 years than over 5 years. So I'd rather lose my premium bond, the premium, because it goes down to 1,000 at the end. I would rather lose that at over the long haul than the short haul. So whenever you quote a bond, you have to go with the worst price. So you're always going to quote the earliest call date. Judy, I'm happy for you. That's awesome. I love that. That's my favorite thing to see that I got it. Okay. Because that means I can stop rambling. Okay. Now, Julie, let's see what you got. Okay. Ooh, a whole chart. Okay. So, yeah, I don't know how to remember this other than, so if I do an IPO, they're asking if I get an IPO from the effective date till what day do anyone who buys it still have to get a prospectus? So if I buy stock after the effective date of an IPO, I have to send a prospectus to anyone who buys it within a certain amount of days. I'm not asking when it's delivered, because we know that if you're getting a prospectus, you have to get it by completion of the trade. You know that if you buy a stock that get it, or something that gets a prospectus, you have to get that in the mail or email or a link by the time the deal is completed, which is settlement T+2. So now, as far as when you buy shares, so say the effective date's May 1st, for how many days after that do you have to get it? So here's what it is. If it's an over-the-counter, it's 90. So the only numbers you have to remember is 90, 40, 25. 90, 40, 25, okay? So now, if it's an IPO, the first 90 days is you get a prospectus. Close. Your answer. Now, if it's an over-the-counter, it's 45 days. So again, an IPO over-the-counter is 90 days. An additional offering, which means you issue a second, third, fourth time, it's 40 days for over-the-counter. If you do an IPO on an exchange like WeWork almost did, but like Uber did, or I think Uber did, I can't remember anymore, Facebook, it's only 25 days. So again, it's 90 for over-the-counter IPO, 40 for an additional over-the-counter. So those are the bigger numbers, because over-the-counter is riskier. You can't really say that, but that's the way you have to think, that over-the-counter is riskier. So IPO on an exchange, that there's a million guys, there's a million people researching, covering it. So they only make you get a prospectus for the first 25 days after the issue. Okay. And then if it's an additional on the exchange, then it's 0. So Google in 2004 went public. Anyone who bought shares for the first 25 days had to get a prospectus. After that, you don't. Now, 2 years later, they did another raise, a follow-on or an additional, no prospectus required, because they don't need it, because it's been trading on an exchange and it's somewhat safe. Okay, I hope that helps. Now, I don't think for the SIE they will worry about this, but let's talk about this for a second. So if I'm the manager of an IPO, if I'm the manager, I'm the book runner, I'm running it, okay? What happens is I cannot do, there's a lot of things I can't do, and there's a quiet time for research. So what happens is, I can't do research, because think about it. If I bring it public and I do a research report, you know it's going to be positive, and it's going to look like I'm pumping the stock up. So they're going to tell me that as a manager or co-manager of a deal, for the first 10 days after the IPO, I cannot publish a research report. If I'm just, and basically that works for anyone. So basically anyone who's part of the underwriting group cannot issue a research report for the first 10 days. That's IPOs. IPOs, there's a lot more rules on them, because it's the first time and they're not out there. So again, IPO, anyone who's involved in the deal has to wait 10 days before they can start publishing research reports. If I'm not part of the deal, I can do a research report the next day, because they're worried that you're going to look like you're pumping it up if you're part of the deal. Now, if it's an additional, what they call a follow-on, an additional, it's a lot less, because it's already trading. So if you're a manager, you have to wait 3 days after the effective day. If you're just part of the fund, you don't do anything. I don't know how those to remembered, other than the only numbers are 10, 3, and 0. 10 for IPOs, 3 for 3 for managers, underwriters of an additional, and then nothing for underwriters. Masako, I'll work on that. Okay, so now let's see what else. Okay. So here's the thing on that. Here's a question. An investor is long 200 shares of ABC stock at 58 and short 160 call at 2. So the reason that it is only 1, so what you have to do is this. Okay. Now, if you get, most of the questions on the SIE are going to be 200 shares, 2 options, 100 shares, 1 option. But if they're not, you have to kind of adjust it. So remember, if they're the same numbers, it's easy. Stock and a premium. So it's either stock plus or minus the premium. So if you buy stock and you buy an option, you're adding. Or if you sell stock and you're selling an option, you're adding. So if they're the same, a buy and a sell, you add. If it's a buy-sell, you subtract. That's the start. If they're the same, and 99% of the questions are going to be the same. So now the difference is that if it's a different amount. So this is what I do. If you buy 200 shares and you sell 1 call, I just count half the premium. It's my own brain. So if I buy 200 shares and I sell 1 call, I do half the premium. If I buy 200 shares and I sell 4 calls, I do twice the premium. Or the other way to do it is actually just do the math. Go, okay, so I'm long 200 shares of stock at 58. So that's 200 times 58, whatever number that is. Then I multiply 1 times 200, which is the call. And then I just subtract them, and that's the number I get. So whatever 200 times 58 is, I should know this, but I know that we never do anything without a calculator, right? Ever, ever, ever. So we always use a calculator. So 200 times 58 is 11,600. I sold the call for 2. That's 200. So 11,400 divided by 200. And you go back, you bring it back down by the shares. It's 57. So, okay. So again, don't worry about the amount of questions you're going to get where they do that is so minimal that if you don't remember how I do that, don't sweat it. Let it go. The vendors will do it to you all the time. Notman, Kaplan, they love to do that to you when they're not in it. Pest Perfect will destroy you on options. She's online now. She showed me the SIE. Their analysis, they're making you common stock dividends and had the dividend ratio. I don't even think they do that on the top off, not let alone the SIE. Okay. So the question is, yes, you add or subtract, but if they're different size options, you kind of have to do the total money and then divide it back by the number of shares. Okay. Now, defeasance. I think Misako asked about defeasance. Okay. So first of all, to know the difference, defeasing the debt, escrow to maturity, pre-refunding, advance refunding on this exam are the same damn thing. So basically it goes like this. If I'm a muni issuer, I'm New York City, and I issue a 5% bond, I have to pay $5, $50 every year. Let's say it's $10,000 worth of a 5% bond. So I'm paying $500 every year. Say interest rates drop to 2%. So I'll go, I don't want to pay 5% anymore. So I'm going to go issue a new bond for 10 grand to other people for 2%. And I'm going to use that 10 grand by selling it to pay off the old bond. That's just refunding. That's done. That's refinancing. Okay. What part? The options? Defeasing might be top off, but we're getting there and it could show up. Just to understand the concept. Now, defeasing the debt is if I have a bond, the same situation, I have a $10,000 5% bond, but it's not callable. So I can't call it back. So what happens is I am going to issue a bond anyway at 2%. So I now have $10,000 from issuing a new bond. And then I use that money to buy 5% treasuries. Take 10 grand and I buy $10,000 worth of 5% treasuries. So let's see, if I have a $10,000 5% bond I issued in the first place, I owe $500 to you. I then buy a $10,000 worth of 5% treasuries and they're paying $500 to me. So I owe you $500, I'm getting $500. So why don't I just attach the treasury to you? And then as the treasury pays, it pays you and not me. So now I don't care about you anymore because you've been defeased. I attached the treasury to your bond. So now you are getting $500 a year, whatever. I know I say a month, but $500 a year from the treasury. So you have no default risk. The credit rating went up. So the credit rating goes up. There's no default risk. You're happy. Where I'm happy because the only bond I have to worry about paying is the 2%. If you didn't get that and I went too fast, you can always stop and replay it and slow it down. Other than that, Michael, so how are you doing? I mean, I'm hoping you're doing okay. You're taking it tomorrow. So I hope you're at least in the 75, 80 range on stuff. I don't know. I hope you're reading. Make sure you know the risks. Make sure you know the regs, like the FINRA rules. You have to know like money laundering and stuff like that. So here's a question for you. What's the difference between a CTR and an SAR? And I did it. So if you guys don't know this, you're not watching my old stuff. So a CTR is if you just happen to put more than 10 grand in cash into account, or you withdraw more than $10,000 in an account. Okay. If you do that, so if you put 10 grand in cash or take out 10 grand in cash or money orders or anything cash equivalent, we have to follow CTR. It's not a problem Perfect. Yes, perfect. It's not a it's not you're not in trouble. They do hundreds of thousands a day. Every bank in the world probably does 1,000 of them just because people play with cash and they put it in and out. Now, the issue is maybe you don't want it to be reported, so people will put in like 9,500 or 6,000 every day for 3 days. That could be what they call a red flag because you're structuring it. You're trying to keep it below the reporting limit so that you can get in trouble. That's not always a violation because you may find out the guy like runs a strip club, or I'm kidding, but or some place that's very cash heavy and that's how he does it. That's fine. But if you find out he's actually has 15 grand and he's breaking it up so he doesn't report it, that could be a problem. And that would be a red flag. And if he is doing that, then you would probably file a SARS, an SAR, suspicious activity report. You actually wouldn't do it. It'd be the principal. You have a red flag program. Red flags are like if they don't care about commissions or they wire to, yes, that's perfect. That's a SAR, suspicious activity report. That's where if they wire to unrelated accounts. Now pay attention. Wiring to the family is totally fine. Wiring to the family is always okay. But wiring to like the Cayman Islands or the Isle of Man or Syria or anywhere where Switzerland and stuff, those things and to unrelated accounts, they might be a red flag. They might kick off a SARS. The SARS is never ever tell the client about a SARS. You can't. You'll get in trouble. It has to be a very closed group of people do it. Registered reps don't usually do it. They just kick the red flag up and they will never know if their principal filed one or not. But here's the thing on this. The CTR, they do it all the time, not a big deal. You have 15 days to do it. The SARS, you have 30 days. The reason is because if you file a SARS, you're effing that guy's life up or that person's up because they're now you're sending that to the federal government to be investigated. So that's why they give you up to 30 days to make sure your T's are dotted and your T's are dotted and your I's are crossed. Okay. No, I'm kidding. But that's where we are with this. Okay. So I think that works. Any other questions? Again, probably not doing next Tuesday. I might do Monday night, but I doubt next Tuesday because Christmas Eve and Santa might be flying around, and I want you guys to make sure you can get your stuff. Okay. Michael, good luck tomorrow. Make sure you get sleep. Don't cram. You should be done by now anyway. But make sure you reread that. If you have STC, use their crunch time facts. Oh, so I can do that. So, yeah, thank you. So I'm going to do a quick one on that because it's not super big. So if it's STC, they have, okay. If they have STC has crunch time facts, Notman has class summary. I think Kaplan has the same thing, okay? So anyone who's taking it tomorrow, if you have STC, go through that crunch time facts. That's kind of what people saw in the exam. It's kind of a feedback on it. So no, you're going to be fine. You're going to be fine for this. Okay, so now puts and calls. I've done videos on those, and actually, I don't want to say it, but I think Test Geek does them. Puts and calls, I'm going to do very quick on that, and then ETNs. Buying a call, calls give you the right to buy. Puts give you the right to sell. There you go. I'm telling you, I have a video on it from before, and look up Test Geek, I think does it. There's somebody who does some good option stuff. If not, we can always do that next week or whatever. Now, ETN versus ETF. Okay. Oh, by the way, if you're doing SIE, don't sweat it too much. You're going to get 1 or 2 questions on it. It's going to feel like more, but you're not going to do. Okay. Kaplan, I don't know. I think they have one of these crunch time facts or like quick fact things. I don't know. But go on Reddit. You might be able to find something. Now, Merry Christmas. ETNs versus ETF. ETF is an exchange traded fund. It is actually like a mutual fund. It's a closed-end fund. It's like a closed-end fund. It's a packaged good. It is considered equity, and you're actually buying the fund that holds the shares. They are not they're not actively managed, they're passively managed. So they kind of just track an index. They have leverage ones, which you can buy 2 times or 3 times. So what they do is they use margin and options, not that it matters to you, to increase the return. So you buy an ETF, it's equity, it trades on an exchange, you buy it at the market price plus a commission, but it is absolutely equity. If you understand mutual funds a little bit, you should understand an ETF, but it's passively managed. You can buy it on margin. You can sell it short. You can buy it at 10 in the morning and sell it at 2 in the afternoon, and you can make money. That's why they're different than mutual funds, which mutual funds, they don't trade. You buy them at the close, pretty much at the NAV that the mutual fund tells you it is, plus a sales charge. So ETFs are equity. You can trade them, and they are liquid, and you can buy them on specifics. You can buy inverse ETFs, which basically you're just betting against the market. Now, ETNs are debt. ETNs are debt. Remember that ETN, anytime you see the word note, it's a debt of some sort. Okay. So now, debt, so ETN is a debt. So your biggest risk is credit risk. Remember that. But an ETN does this. You give me $1,000. I'm going to give you back your money in 15, 20, 30 years, whatever it is, maybe even 5 years. But you're not going to get anything until then. So what's going to happen is you're going to get that. You're going to get them. You're going to give me the money. I'll give it back to you in 20, 30 years. But I'm going to pay you whatever the index or security we're tracking over the next 30 years. I'm going to give you to the end. You're not buying it for income. So basically, if say you give me 1,000 and in 20 years I go, oh, the index we're tracking is up 32% over that time, I'm going to pay you 1,000 plus 32%. So you actually don't know what your return is going to be until the end. And remember, you do not buy ETNs for income. Okay, good. Babar, I think. Okay, so you're taking the 6 on Monday. Okay, so now I don't know how close you got, but remember this. So the biggest thing is, and I did the Series 6 video, it's back there somewhere. There's one on just mutual funds. Some kid took it today. Find the suitability one because he said it was real. You're welcome. So he said it was really helpful. He said it today. He said it was super, super helpful. And it nailed everything. Biggest thing you can do, I don't know what books you're using, but you need to know the risks. But you need to know the suitability. You have to know that if somebody wants, if I want looking for income, what do I do? If I want growth, what do I do? Okay, so that's fine. So I hope you've been reading. For the next 4 days or 5 days, you have to focus on reading and adding knowledge. You can do tests, and I'm sure everyone in the world is telling you to take a lot of tests. Everyone you meet is probably saying, take tests, take tests, take tests. For the SIE, it works a little bit. For certain exams, it does, maybe even the 63, but you got to read. I would even read the book again. Go online. I have the one video. I have the suitability video, all these things, okay? Don't test. It is horrible advice. For the SIE, you can do it after you've read everything, okay? Everyone in the world saying test all you. Remember something. Most of the people giving you advice have not taken these exams. They're only a year old. So unless they're 23, and why the hell would you take advice from a 23-year-old? No offense, but they don't know anything about the exams yet. If they're older, yeah, I get it. Everyone's telling you, don't do it. You got to read and add knowledge. Okay. And again, if you want, one of the girls on here said she tried Achievable, the one in my link. She said it's really helpful. It's only for SIE. They're working on the other ones. They haven't gotten there yet. So I have a link for the Achievable. It will help you on the SIE. Not if you're taking it tomorrow, don't bother. Although they have a free trial, it can't hurt. Okay, so now everything is about the reading. So again, Babar is I think it's I'm assuming. So because it shows up as that. So now if you focus on the reading, get down the differences between the funds, like Class A, Class B, Class C, that's just a sales charge, close end versus open end. Couple people said they saw quite a bit on communications, like correspondence, retail, and institutional. So correspondence is basically under 25 or less, with no approval needed. Retail is 25 or more. Remember, these are individuals, whether they're customers or not. Or 25 or more is considered retail, and it needs pre-approval by a principal. And if it's all institutions, you don't need pre-approval at all. Okay. So I do have to go because I have another student going on, and I have a student going on in about 5 minutes. I will try to do Tuesday. Look, if you're taking it this week, it doesn't matter. Good luck. Get sleep. So anyone who's taking the next 3-4 days, watch the videos again. Watch the suitability. Make sure you read, add as much knowledge as you can. Add knowledge. Don't worry about testing as much. It's good to go back and forth, but there it is. So now, anyone who's taken index after that, I'm going to try to switch it to Monday night because Christmas Eve is secret and everyone's going to be having fun. Okay. You all have a good night. And I have one more student to do, and she just told me she's ready. So I will, I teach till like midnight almost. Okay. You all have a good night. You saw that on my Instagram. Yeah, my Instagram is kind of crap. This is better. Okay. I will talk to you all later. Feel free to email me questions, and we'll go from there. Good night, and please, tranches. I think I have a mortgage-backed security one. I'll see what I can do. I won't be in the next week or so. Well, it'll be, by the way, Dave, if you wait about an hour, it shows up. Okay? It will actually show up. Okay? You all have a good night, and see you, Allie. You call me Friday, right? So everyone, we want to put pressure on Allie to make sure she's steady. She's losing focus. I gotcha. Talk to you later. Bye-bye. Oh, yes, Joseph, I'm going to go, but I have to. Yes, the kid today said he saw a cost basis on the SIE. So make sure we get on that, okay? Cost base, you have to understand, cost base is absolutely in the SIE. Remember, most of the stuff I talk about is interchangeable between the SIE and the 7. Not crazy. It's going to be there, though. You have to know. Watch. I think I did a thing on it. I have no idea. Again, supposedly Test Geek is good. I have nothing to do with him. I've never met him. I have no idea. Oh, somebody found my Instagram. Okay. So let's go with, I have to go because I have to get out of here. We're going to nail this. Okay. Michael, Tommy, you're going to nail it. Laura, I think it's Laura. You're going to, and this will be on here in a couple minutes.